What's up, guys? It's Mr. Fit to Flourish, and this is part 3 of the options trading series on how to trade options. So, without further ado, let's get right into it. Where did we leave off last time? So last time we left off on options. Going long options is a bet. Okay, so that basically just means we're buying calls and puts. We're buying calls and puts. Okay, why would you buy calls? Well, we buy calls because we're betting that the stock is going up, and we buy puts because we're betting that a stock is going to go down. So this is a way to leverage your money. And leverage just means you put a small amount in to get a large amount out, okay? So what is a call option? Call option is reserving the right to buy a stock at a certain price because you think it's going to go up, okay? Call price increases as a stock price increases. So the price needs to go up in order for you to make money. So the stock price needs to go up in order for your calls to start making money. So if you are wrong and the price of the stock starts to go down, then your call contract, your option contract is going to decrease in value and you're going to lose money. The cool thing about options is you can only lose as much as you put in. So if you buy calls and you buy $100 worth of call option contracts, then if it goes all the way south, then you can go to zero. But that $100 goes to zero and no more. So you need to understand when you're trading options, whatever you put in, you need to understand that options are wasting assets, meaning that they're not going to just hold their value. They decrease in value over time, and they can actually go to zero. So whatever you put in, you need to understand that risk and be willing to let it go to zero if it does. Okay, and if you put in like $10,000 and you're not willing for that to go to zero, not willing to let it go to zero, then you're probably putting in too much size on the trade. It's a very easy way to understand how much you should be putting into options trades. Okay, just knowing that whatever you put in, understand it can go to zero. And if you're not comfortable with whatever you put in going to zero, you're putting too much in on the trade. Okay, you're too invested, too heavily invested, I might say. Options further explained. So call options. So you're buying a contract because I think the price is going to go up and I want to buy the stock cheaper than the high price it will be. But at the same time, I want to sell it at that super high price. So for example, the current price of Apple is $43. I think it's going to go up to like $50. So I buy a 0.13, so a $13 call with a strike price of $45. This means I think that the stock will at least move to $45. So remember, the stock is currently at 43. I think it'll move at least to 45. And I'll buy the 100 shares for $45 each. Or if it indeed goes to 50, I get to buy them for $45 each and sell them at that new price of 50. Okay, so I'm reserving the right to sell these contracts at the $45 that I think it might go up past. Okay, so call options is reserving the right to sell an equity at that price. So the contract is like a placeholder. Okay, so I only paid $13 to be able to make a $500 spread. Okay, $500 spread. So this is pretty cool. Now remember, intrinsic and extrinsic value. Okay, so intrinsic value, so the amount that an option contract is actually worth, the intrinsic value is equal to this equation. People don't talk about this, so pay attention. So the stock price minus the strike price. That is how much the option contract is actually worth. So this is what you can turn in the option for, your exercise right. So again, if we go back to that example, if I exercise my right to sell Apple at $45, remember, $45 per share times a block of 100 shares because it's an option. Okay, it's an option contract. It gives you control over 100 shares. So 45 times 100 is 4,500. But then if the stock actually goes up to $50, I can sell excuse me, I can sell that 100 shares for $45. Okay. Or sorry, I could still I could still buy for $45. Okay. If it goes to 50. So the difference is 5,000 minus 4,500. So the spread that I'm making here is 500. Okay. 500. So my bad. It gives you the right to buy. Sorry, it gives you the right to buy at that price. I think I said sell earlier. It gives you the right to buy these contracts or these shares at that given price. Okay, because you think that the price is going to go higher. You don't want to be buying it expensive. Okay, so the difference between those two prices is what you're going to get in terms of the spread. So the intrinsic value is equal to the stock price minus the strike price. So what you can turn the option in for, the in the money portion. Okay. Now, extrinsic value of a option contract is just volatility and time. So the more volatile the stock is, the underlying, or if there's events around it like earnings upcoming, things like that, that'll cause a spike in volatility, which will cause a spike in the option contract price. And then the more time you have to reach a certain strike price. So like if it's a week out, 2 weeks out, 3 weeks out, the further out in time that you have to till the option expires, then the more that option contract is going to be worth. So the extrinsic value is going to increase. Okay. In the money options have extrinsic and intrinsic value. Out of the money options have no real value. They only have extrinsic value because you can't yet turn that contract in for any amount of money because we haven't reached that price yet. Okay. Now, one thing to understand is that all options expire. So the closer you get to the option's expiration date, the less valuable the option becomes. Options expire worthless. People typically trade or sell their contracts once it becomes more valuable. So for instance, like if you bought that option contract for $13 and then Apple starts to move up, so your contract starts to increase in price, it goes from $13 to $26. Well, you just made 100% gain on those contracts. So typically people will sell. They'll be like, oh, I just made 100% on my investment, so I'm going to sell it. I'm not going to wait and exercise this contract. I'm going to sell it at 100% gain. That's typically what most people do. 99.99999% of people, except if your name is Nancy Pelosi. All right. So time value. So in terms of time value, the more time your option has to reach the strike price, the more expensive it will make the contract. 0 days to expiration contracts. These are 0 DTE. Okay. So this is what you'll hear all the time. You'll hear 0 DTE. So 0 DTE. So 0 DTE, they have almost no time value. They only have volatility. Okay. And then if it's in the money, it'll have some intrinsic value. Okay. So how does time decay work? So time decay does not work linearly when it comes to option contracts. The closer you get to the expiration date, the more parabolic things seem to go in the downward direction. So about 90 days out, you have very little theta decay, so very little time decay. And then about 60 days out, it builds up just a little bit more. And then once you get 4 weeks and less, it starts to increase in terms of how much the option contract will decrease in value. It kind of goes crazy. So just be aware of that. All right, so buying a call. So another explanation of that example we had was the current price of the stock was $43, the current price. Okay. The strike price, which is the price that we bought the contract at, was $13. So we bought that contract for $13 because we're betting that the stock is going up. We're buying calls at the $45 strike price. Okay. So again, nomenclature, the naming system is that $43, if we bought an option contract that was at the current price, that would be at the money. But since we got it at a price we have not yet reached, the $45 strike price, that is considered out of the money. It's a price that we have not yet reached yet out of the money. In the money are prices that we already have passed, and they're usually more expensive. Those contracts are more expensive than the out of the money contracts because remember, they actually have intrinsic value. I can turn these contracts in to purchase shares at these given prices. But out of the money contracts, we have not reached those prices yet. So there's no intrinsic value. And notice how out of the money, it gets cheaper to buy those contracts. These contracts are cheaper. Okay, and then here's a picture that comes from another YouTube video that kind of shows you like, hey, calls, if this is the strike price, 125, and we've already passed 120, we already passed 115, that means that this side is in the money. And the prices that we haven't reached yet are out of the money. Now it's the opposite for puts. So for puts, passing, since we're thinking that price is going down with puts, in the money would be in the upward direction, and out of the money in the downward direction, because we're thinking that the stock price is going to go down. So just probably want to screenshot this here. Okay. Now put options. So what is a put option? A put options are put contracts. Price increases as the stock price falls. So you reserve the right to sell a contract at a certain price because you think the stock price is falling. So you're bearish about a stock, and it's a way to hedge against your positions. So pretty good way to hedge. Okay, and then it's a little bit different for puts. Like I said, out of the money would be the prices that we have not yet fallen to, while in the money are prices that we already fell below. At the money is the current price. Okay. And then here's some different nomenclatures for option transactions. So buying to open, selling to close, selling to open, buying to close. Okay. And then the option Greeks we'll talk about in our next video. So hopefully you guys learned a lot from this part 3 of the options, getting into options. But part 4, we'll talk a lot about the Greeks, how the Greeks work in terms of moving stock prices. So hopefully you guys enjoyed this series so far. Stay tuned for the next video. Good morning, welcome to the Fit to Flourish podcast. Let's talk wellness, finance, and growth.